Welcome back to the deep dive. Today we're going to be looking at Dividend Kings. You sent over some articles about these investment powerhouses, and, well, we're here to help you make sense of it all.
Yeah, Dividend Kings. It's a fascinating area to explore. These are companies that have consistently increased their dividend payouts for over half a century, 50 years. It's incredible. It really shows their commitment to their investors through thick and thin.
And it's not just paying dividends, it's consistently increasing them, right?
Yeah.
That's got to be a really good sign of stability, especially in today's kind of unpredictable economy.
Exactly. It speaks volumes about their long-term vision, their ability to navigate different economic climates. And you know what? You've actually highlighted two Dividend Kings in particular as potential picks for 2025.
Yeah, I found this really interesting. But before we get into those specific companies, maybe we should step back for a second and talk about why dividend investing in general has become so popular, right? I mean, one of the articles you sent actually cites some research from JP Morgan Asset Management showing that dividend stocks have historically outperformed non-dividend payers by a significant margin. Like, are we talking a little bit or a lot?
Oh, we're talking a lot. I mean, we're talking an average annual return of 9.5% for dividend stocks compared to just 1.6% for their non-dividend paying counterparts over a 40-year period.
Wow, that's a huge difference. So it's not just about a little extra income. It seems like dividends can really play a significant role in driving long-term investment growth. And what's really interesting about this research is that it also highlights the power of compounding, which I think is something a lot of people don't fully grasp.
Compounding is definitely a game changer. It's like a snowball effect. Those dividends get reinvested, generating even more dividends over time, and it just keeps building and building.
Yeah, and it's not just theory. According to Hartford Funds, dividends have contributed a whopping 34% to the total return of the S&P 500 since 1930.
Exactly. That's over almost 100 years. It's not a short-term blip, it's a long-term trend. Dividend stocks are a force to be reckoned with.
All right, so we've established that dividends are a force to be reckoned with, but let's circle back to those Dividend Kings. What exactly sets them apart from other dividend-paying companies?
It all comes down to that incredible track record of consistent dividend increases. 50 years. Think about all the economic ups and downs over that time. These companies have not only weathered those storms, but they've also continued to reward their investors through it all. That kind of consistency just screams financial strength, a commitment to shareholder value, and a focus on long-term growth.
Okay, so it's like they've earned their stripes, they've proven themselves over time. It's no wonder they're considered the elite of the dividend-paying world. And the fact that only 51 companies out of thousands actually make the cut, that really underscores their exclusivity.
Absolutely. They're the cream of the crop.
So let's dive into the first Dividend King that caught my eye. PepsiCo, ticker symbol PEP. Now, the article touts it as a top pick for 2025, but their stock actually dipped 10% in 2024. So how should we interpret this? Is it a red flag or a potential buying opportunity?
Well, it's important to look beyond the headlines and really delve into the underlying fundamentals of the company. And with PepsiCo, it's interesting to note that they're not just a beverage giant.
Yeah, everyone knows Pepsi, right?
Right, but their Frito-Lay division, which includes brands like Lay's, Doritos, and Cheetos, actually generates more revenue than their beverage business.
Wow, I had no idea. So they're a snack powerhouse, too. That's a lot of chips and dip. But even with that diverse portfolio, their stock still dipped. What kind of information should we be looking at to assess whether this dip is a concern or an opportunity?
Well, one key metric to consider is the dividend yield. PepsiCo's current dividend yield is 3.6%.
Okay, 3.6%. But what does that actually mean for potential earnings? Can you break that down for us?
Sure. Imagine you invest $100 in PepsiCo stock. With a 3.6% yield, you'd receive $3.60 in dividends annually. Not bad, right? And what's even more encouraging is that their dividend payout has been growing at a steady 8% compound annual growth rate over the past decade.
Okay, so 8% growth on top of that 3.6% yield. That starts to add up pretty quickly, especially with compounding. So despite the recent stock dip, they're still generating solid dividends with a history of consistent growth. What about their future prospects? Are they expected to keep up this momentum?
Well, analysts are projecting earnings to grow at a rate of 8% annually moving forward. This suggests that there's still potential for both stock price appreciation and, of course, continued dividend increases.
That's encouraging. But, of course, we always have to remember that projections are just that. They're based on assumptions about future performance, which, as we all know, can be impacted by a lot of different factors.
Absolutely. The future is never certain, and there are always risks involved with any investment.
So, what's the bottom line for someone considering PepsiCo? Is it a buy, a hold, or a maybe?
Well, I'd say PepsiCo represents a solid option for investors seeking stability and income. Their diverse portfolio, their history of dividend growth, it all suggests resilience. But their recent performance does raise some questions about their future growth trajectory. It's not a slam dunk, so it's important to weigh the potential risks and rewards carefully before making a decision.
So, not a guaranteed home run, but definitely a player worth watching. Now, let's switch gears and look at the other dividend king on our list. Johnson& Johnson, ticker symbol JNJ. They also experienced a dip in 2024, about 8%, but interestingly, their dividend yield is at a historically high level of 3.4%. What's the story there?
Ah, Johnson& Johnson. It's an interesting case. One of the things that jumps out is the potential impact of political uncertainty. The article you shared highlights some concerns about the new administration and how their policies might affect the healthcare sector, which of course is Johnson& Johnson's bread and butter.
Right. So we're not just talking about numbers on a spreadsheet here. We're talking about the real-world impact of political decisions. It's a reminder that investing isn't just about crunching numbers, it's also about understanding the broader context in which those numbers exist.
Precisely. So the question is, how do we factor this political uncertainty into our assessment of Johnson& Johnson as a potential investment?
Right. I mean, healthcare is generally considered a pretty stable sector. People always need medicine, medical devices, all that stuff, no matter what the economy is doing. But this new administration could shake things up, right? So how do we balance that potential disruption against J&J's inherent stability?
That's where we need to look closely at J&J's financial health. And the good news is they have a strong balance sheet, consistent cash flow, and a commitment to investing heavily in research and development.
So they're not just sitting back and waiting to see what happens. They're actively preparing for the future, trying to stay ahead of the curve.
Exactly. And that proactiveness is a good sign. It suggests that they're not just reacting to potential challenges, but are actively positioning themselves for future growth.
So we've got two very different dividend kings here. PepsiCo, the food and beverage giant with a diverse portfolio and a history of consistent dividend growth, and Johnson& Johnson, the healthcare powerhouse trying to navigate the choppy waters of political uncertainty. How do we even begin to compare these two?
It's a tough call, isn't it? They both have their strengths and weaknesses. I think the key is to really think about your personal investment goals and your risk tolerance. Are you looking for a steady, reliable income stream? Or are you willing to take on a bit more risk for the potential of higher growth? Both PepsiCo and Johnson & Johnson offer the potential for solid returns. But it's about understanding the nuances of each company's situation and determining which one aligns better with your investment style.
So there's no right or wrong answer. It's about finding the right fit. But wait, there's more. We've only focused on these two, but there are dozens more dividend kings out there. What are some other insights you can share about this elite group of dividend payers? What other factors should we be considering as we explore this world?
Oh, there's so much more to discover, and that's what makes this exploration so exciting. There are so many potential investments to uncover, each with its own unique story to tell. And remember, this is just the start of your deep dive. There's a whole world of information and insights out there waiting to be explored. Keep researching, keep asking those tough questions, and most importantly, keep learning.
Okay, so you've got me thinking about all these other dividend kings out there. This article mentions that there are 51 companies that make the cut. What else can you tell us about this elite group?
Well, one interesting thing to note is that dividend kings, they come in all shapes and sizes. While most tend to be large-cap stocks, those with massive market valuations, between $10 billion and $200 billion, it's not all mega corporations.
So there's some variety.
Yeah, you'll find a good mix in there, with about a fifth of them being mid-cap stocks and even a handful of small-cap companies sneaking onto the list.
So it's not just about size, then. What kind of industries are typically represented among these dividend kings?
You'll find quite a few consumer-facing companies and industrial stocks, household names, brands you interact with every day. But there's also a significant presence from the utilities sector, which might surprise some people.
Utilities, that's not exactly the most glamorous industry. Why are they appealing to dividend investors?
Yeah, true, but that's kind of the point. Utilities have long been considered what we call widows and orphans stocks because their dividend payments are so reliable. It's like clockwork. Rain or shine, people need electricity and water, so these companies tend to have very stable earnings, which translates into reliable dividends. They might not offer the same growth potential as some other sectors, but they provide that level of predictability and consistency that many investors find attractive, especially in times of economic uncertainty.
Okay, makes sense. So we've got a mix of consumer goods, industrial giants, and steady Eddie utilities. It's almost like a diversified portfolio built right into the Dividend King concept.
Precisely. And that diversification can be a real advantage for investors because it helps to spread risk across different sectors of the economy. By investing in a range of Dividend Kings, you're essentially building a portfolio that's designed to withstand, a variety of economic conditions.
This is all starting to sound pretty compelling, but let's be real for a second. Every investment strategy has its downsides, right? What are some of the potential drawbacks of focusing on Dividend Kings?
That's a great question. And it's important to be aware of those potential downsides before making any investment decisions. One thing to consider is that Dividend Kings, they're often mature companies. They've already established themselves in the market and have a long track record of success. This can be a positive in terms of stability, but it also means that their growth potential may be limited. They're not likely to experience the same explosive growth as younger, more innovative companies.
So they're like that reliable old family car, gets you where you need to go, but it's not exactly going to win any races.
That's a perfect analogy.
So you're not necessarily going to see those like huge overnight gains, but you can count on them to chug along steadily and provide that consistent income stream.
Exactly.
Are there any other potential downsides?
Well, another potential downside is the risk of dividend traps. We've all heard those horror stories about companies that suddenly slash their dividends, leaving investors high and dry.
Oh yeah, that's got to be a dividend investor's worst nightmare. But wouldn't a company with a 50-year streak of dividend increases be less likely to fall into that trap? I mean, that's a pretty impressive track record.
You would think so, right. And for the most part, you'd be right. That long history of dividend increases is a strong signal of financial strength and a commitment to shareholders. But it's still important to remember that past performance is not always indicative of future results. No company is completely immune to economic downturns or unexpected challenges or, changes in management strategy.
So it's like that saying, trust but verify. Even with Dividend Kings, it's crucial to do your homework, analyze their financials, understand their business model, and assess their long-term prospects.
Exactly. Don't just rely on the dividend track record alone. Dig deeper. Ask the tough questions. Make sure you're comfortable with the level of risk involved before investing your hard-earned money.
Okay, so we've talked about the pros and the cons. What's the big picture takeaway for our listeners? Who should be considering Dividend Kings as part of their investment strategy?
I think Dividend Kings can be a great option for investors who are looking for a combination of income and stability. They're particularly well suited for those who are nearing retirement or are already retired and are looking for a source of steady income to supplement their pensions or savings.
Yeah, that makes sense. They're looking for companies that are less likely to experience wild price swings and more focused on steady long-term growth.
Exactly. And, they can also be a good choice for younger investors who are just starting out and are looking for a way to build a solid foundation for their portfolio.
So if you're looking for that set it and forget it type of investment where you can sleep soundly at night knowing that your money is working hard for you, Dividend Kings might be worth a closer look.
Absolutely. But again, it's crucial to remember that no investment is foolproof. It's always important to diversify your portfolio and do your own research before making any decisions. Don't put all your eggs in one basket, even if that basket is filled with Dividend Kings.
Sound advice. Now, you mentioned diversification earlier, and I'm curious to know more about how Dividend Kings can fit into a broader investment strategy. Should they be the core of a portfolio or just a supporting player?
That really depends on your individual goals, risk tolerance, and time horizon. For some investors, Dividend Kings might be the cornerstone of their portfolio, providing that solid base of income and stability.
Kind of like the foundation of a house. You build everything else on top of that solid base.
Exactly. But for others, they might be more of a complementary holding, adding diversification and income potential to a portfolio that's primarily focused on growth stocks or other asset classes. There's no right or wrong answer here. The key is to find the right balance for your individual needs and circumstances.
So it's all about finding that right balance. There's no one-size-fits-all approach to investing. The best strategy for you will depend on your unique situation. This has been a really illuminating conversation. We've covered a lot of ground, but I still have one burning question. If someone is interested in exploring Dividend Kings further, where should they start?
Well, the first step is to do your research. There are plenty of resources available online and in libraries that can help you learn more about Dividend Kings and the criteria for inclusion on the list.
Yeah, I was going to say probably a good starting point would be to just look at the list of current Dividend Kings and see which companies stand out to you.
That's a great idea. You can find the list of Dividend Kings on various financial websites, and it's a good way to get a sense of the types of companies that qualify. Once you've identified some companies that pique your interest, the next step is to dig deeper into those companies. Look at their financial statements, read analyst reports, and consider their long-term prospects.
So it's like detective work, right? You're gathering clues, trying to figure out if this company is a worthwhile investment.
Exactly.
You're looking for companies with strong fundamentals, a history of consistent dividend growth, and a bright future ahead of them.
Exactly. You're looking for companies with strong fundamentals, a history of consistent dividend growth, and a bright future ahead. It's not just about chasing the highest dividend yield. It's about finding companies that are built to last and have a proven track record of creating value for their shareholders.
That makes sense. It's not just about the quick buck. It's about finding companies that are in it for the long haul.
And that's where the real value of Dividend Kings lies. They're not just about generating income. They're about investing in companies that are committed to creating long-term value for their shareholders.
So we've talked about where to find information about Dividend Kings. But what about actually investing in them? Is there anything special investors need to know?
Well, the good news is that investing in Dividend Kings is no different than investing in any other stock. You can buy and sell them through a brokerage account, just like any other publicly traded company.
Okay, so no need to jump through any special hoops.
Nope. It's all about doing your research, making informed decisions, and having a clear investment strategy.
But as with any investment, it's important to have a plan, right? Know why you're investing in Dividend Kings, what your goals are, and how much risk you're comfortable taking.
Exactly. It's not enough to simply say, I want to invest in Dividend Kings. You need to understand why they align with your investment objectives, what role they'll play in your overall portfolio, and how you'll manage your investments over time.
This has been a really illuminating conversation. We've covered a lot of ground, from the basics of dividend investing to the nuances of Dividend Kings. But I can't help but wonder, is there anything else out there that's similar to Dividend Kings? Maybe something that could complement them in a portfolio?
That's a great question, and one that leads us to another fascinating group of companies. We've talked about the kings, but have you ever heard of the dividend aristocrats?
Dividend aristocrats? That sounds pretty fancy. Who are these elite companies?
Dividend aristocrats are a select group of companies that have increased their dividends for at least 25 consecutive years.
Oh, okay.
They're like the younger siblings of the Dividend Kings, with a slightly shorter but still impressive track record of dividend growth. They haven't quite reached that 50-year mark yet, but their consistent commitment to increasing dividends suggests they're on a solid path to potentially becoming Dividend Kings in the future.
Well, they're like the up-and-coming royalty, maybe a little bit more growth potential, but not quite as much history and stability as the kings.
And the interesting thing is there's some overlap between the two groups. Many Dividend Kings are also dividend aristocrats. But there are also some companies that are only aristocrats, meaning they haven't quite reached that 50-year mark yet.
Ah.
This provides investors with a broader range of options, allowing them to choose companies that align with their specific investment goals and risk tolerance.
So it's like a tiered system of dividend royalty. And for investors who are looking for a bit more growth potential, the dividend aristocrats could be a great place to start.
Absolutely. And that's what makes this whole area of dividend investing so fascinating. There's so much to explore, so many different strategies to consider, and ultimately it's about finding the approach that works best for you and helps you achieve your financial goals.
Okay, so we've talked about these amazing Dividend Kings, the up-and-coming dividend aristocrats, but I'm curious about the bigger picture. What kind of trends are shaping the dividend landscape today? I mean, why is everyone suddenly so interested in dividend-paying stocks?
That's a great question. And it really speaks to a broader shift in investor sentiment, One of the biggest trends we're seeing is this growing demand for income and stability, especially with all the economic uncertainty we've been facing. People are looking for investments that can generate consistent cash flow, help them weather the storms, and potentially grow their wealth over time. And dividend-paying stocks, they really fit the bill.
Yeah, it makes sense. In a world that feels kind of unpredictable, dividends offer that sense of reliability, that steady stream of income that can really help investors feel more secure.
Exactly. And this trend is being driven by a number of factors. I mean, think about the low interest rates we've been seeing. It makes traditional income-generating investments like bonds less appealing, right?
Yeah.
So people are turning to dividend-paying stocks as an alternative.
Right, so dividends are looking more and more attractive in comparison.
And let's not forget about the aging population. Baby boomers are retiring. They're looking for reliable sources of income to supplement their pensions and savings. Dividends can provide that steady stream of cash flow that they need to maintain their lifestyle in retirement.
Yeah, it's like that peace of mind knowing that even if the market takes a dip, you've still got that regular dividend payment coming in.
Exactly. And on top of all that, there's just a growing awareness of the benefits of dividend investing as a long-term wealth-building strategy. People are realizing that dividends aren't just a nice little bonus. They can actually play a significant role in generating those long-term returns and compounding those gains over time.
Right, it's not just about getting rich quick, it's about building wealth steadily and sustainably over the long haul.
Exactly. So it's not just a passing fad. It's a fundamental shift in the way people are thinking about investing.
I love that. It's like a rediscovering of the power of dividends. So what does all this mean for companies? Are they feeling the pressure to step up their dividend game?
Oh, absolutely. Companies are definitely feeling the pressure to return cash to shareholders through dividends. They're realizing that dividend payments are no longer just an option. They're an expectation, especially for companies that want to attract and retain those long-term investors.
Right. So it's a win-win, right? Investors get the income and stability they're looking for, and companies are being held accountable for their performance.
Exactly. It creates this more dynamic and engaging relationship between companies and their shareholders.
I love that. It's not just about the money, it's about building those long-term relationships, that sense of shared purpose and alignment between companies and their investors.
Exactly. And this is creating a virtuous cycle. As more companies pay dividends, it becomes more attractive for investors to invest in those dividend-paying stocks, which in turn puts more pressure on companies to pay dividends, and so on and so forth. It's a self-reinforcing system that benefits both companies and their investors.
It's like that snowball effect, building momentum over time, right? And this trend is likely to continue in the years to come as that demand for income and stability keeps growing.
Precisely. So if you're considering incorporating dividend-paying stocks into your portfolio, now is a great time to explore those options and find companies that align with your investment goals. Remember, this deep dive is just the beginning of your exploration. There's always more to learn, more to discover, and more to achieve in the world of investing. Keep learning, keep exploring, and keep diving deep.
This has been an incredibly informative conversation. Thank you so much for sharing your expertise with us and guiding us through this fascinating world of Dividend Kings and dividend investing.
It's been my pleasure. And remember, the journey of investing is just as rewarding as the destination. Enjoy the process, embrace the challenges, and celebrate those successes along the way.
That's such a great point. It's not just about the end goal. It's about the journey, the learning, the growth, and the excitement of building something meaningful. We'll be back soon with another deep dive into a topic you care about. Until then, keep learning, keep exploring, and keep diving deep into the world of knowledge and discovery.
Happy investing, everyone.
Sure.